Welcome back to Multifamily Deep Dive by Bridgewater Realty Advisors. We are diving today into what is, without a doubt, the single most important tool keeping multifamily deals alive in today's market. I'm talking about seller financing.
It really is. The whole market, it feels like, well, paralyzed. Rates are up, seller expectations are still high, and that standard capital stack for an acquisition, it just doesn't pencil.
Exactly. But the smart operators, the resilient ones, they're still finding ways to transact. And seller financing isn't just, some niche option anymore. It's become the indispensable strategy that actually unlocks these deals.
Absolutely. And when we say seller financing, let's just simplify for a second. At its core, it's just the seller stepping in to become the bank.
For some or all of it.
For some, yeah, sometimes all of the purchase price. They're replacing the bank as the capital source, and this is the crucial part, as the gatekeeper.
Right. They set the terms.
They set the terms. In a market where bank rules are tightening every single day, this just opens up a world of possibilities that institutional debt slams shut.
And our mission today is to go way beyond that simple definition. We're going to unpack the 5 main structures you'll see out there.
Mm-hmm.
We'll start with the cleanest one, the conventional note, then move to a really interesting regional specialty, the Louisiana bond for deed.
Which is fascinating.
And then we'll get into the high-stakes stuff, the wraps, the subject to deals. But most importantly, we need to flag the specific, sometimes subtle risks of each one.
And then show you the defensive tactics, the moves that turn a simple handshake agreement into, durable structured security for both the buyer and the seller.
We want to give you the shortcut, the real playbook for understanding this stuff deeply.
That last point is everything. I mean, knowing the legal mechanics, that's baseline. That's just table stakes.
Yeah.
Mastering the defensive tactics like really underwriting your counterparty, negotiating intercreditor agreements when a bank's involved, implementing cash flow controls, that is what separates the pros from the people who end up in really expensive litigation when the deal hits a bump.
And it will always hit a bump.
Inevitably. So we're going to spend a lot of time on those security measures because that's where the real money is made or lost.
Okay, let's unpack this. Starting with the big picture. Why now? Why is this strategy, which was kind of a sideshow during the cheap money era, suddenly exploding? What's the fundamental pressure here?
It's a perfect storm, really. It's a textbook collision of 3 huge market forces, and if you don't get the why, you can't really leverage the how.
Okay, so what's force number 1?
It's the banks. The way banks are approaching lending right now has completely changed. They have become incredibly conservative.
And not just by raising rates?
No, not at all. It's the constraints. We are seeing major lenders apply these really stringent debt service coverage ratio, or DSCR, stress tests with a ruthlessness we just haven't seen in a decade.
Can you break that down? Explain the stress test for someone who's maybe only used to thinking about day 1 numbers.
Sure. So a typical stress test might say your property needs to maintain, let's say, a 1.3x DSCR. That means cash flow has to cover the debt payment 1.3 times over. But here's the twist. It's not at the current rate of, say, 7%. It's at a hypothetical stressed rate of maybe 9 or even 10%.
So they're modeling a future catastrophe.
Exactly. They're building in a buffer to make sure that if rates keep rising or if the property's performance dips, their loan is still safe. And if your underwriting only shows a 1.25 billion DSCR at that stressed rate, the bank just says no. End of story.
So they're demanding these higher rate floors, lower LTVs. I hear 60-65% is common now.
Right. And then they tack on heavier reserves, tighter escrow requirements. So it's not just that debt is expensive, it's that it's incredibly restrictive. The bank's risk model just demands a huge chunk of cash down, which kills the buyer's returns.
Which leads right into the second force, which is sticky owner pricing.
Directly. You have all these owners who've held assets for, 5-10 years. Their entire wealth plan, their retirement, was based on the assumption that the next buyer would get 75% LTV at 4.5%.
A world that is gone.
Completely gone. So they're clinging to yesterday's valuation, a price that today's bank underwriting just can't support. The math doesn't work. The seller has to either drop their price by millions or the buyer has to bring a boatload of cash.
Huh.
And a lot of sellers just refuse.
And caught in the middle is the third force, the capable buyer.
Yes. We have these incredibly talented operators who know they can improve a property's net operating income. They can execute a business plan, raise rents, cut costs.
They can create value.
They can create serious value in 18 to 36 months, but they're completely blocked. The bank only underwrites the property's current, often suppressed performance, not the future potential. So the restrictive bank debt kills the deal before the buyer even gets a chance.
So seller financing becomes the bridge, the pressure release valve for that whole mismatch.
It's the perfect bridge. For the buyer, the benefits are immediate. They get terms a bank would never dream of offering.
Like interest-only periods.
Right? An interest-only period for the first year or two, which dramatically lowers their initial payments. They get higher blended leverage, more relaxed covenants, and a much, much faster closing because you're cutting out all that institutional red tape.
I get the buyer's side. It's a lifeline. But why would a seller who could just take cash today want to do this? Why become a lender?
That's the key question. And the answer is that the clean cash today often comes with a huge price cut that they find totally unacceptable.
So by carrying a note, they get a better price.
A much stronger price, often 5 to 50% higher than what an all-cash or a bank-financed buyer could justify. That's number one. Number two, they get a guaranteed monthly income stream, often at a really attractive yield.
Better than a CD or a treasury bond.
Way better. If you can get a well-collateralized note yielding, say, 6.5 or 7%, that's a fantastic passive return.
And then there's the tax angle, which for some sellers is the single biggest driver.
Absolutely. The third benefit is the potential for huge tax planning advantages through an installment sale.
Explain that.
Okay, imagine a seller has a $10 million capital gain. If they take all that cash in 1 year, they get hit with a massive tax bill.
Right.
But if they structure it as an installment sale, say $2 million down, and the other $8 million paid over the next 4 years, they spread that tax liability across 5 different tax years.
So they can stay in lower tax brackets each year.
Potentially, yeah. It gives them flexibility, allows them to use other strategies to offset the gain, and crucially, it keeps their capital working inside the note instead of just sending a huge check to the government on day one. For a retiring owner, that can be a complete game changer.
So the bottom line is, deals that would otherwise be dead in the water suddenly become financeable. If you're seeing deals stall out, this is the tool you have to master.
It is.
Okay, so seller financing isn't just one thing. The legal structure you choose dictates everything. The risk, the protections, the enforcement. Let's start with the most straightforward structure out there.
This would be conventional seller financing. It's the cleanest, the most recognizable, because it basically mimics what a bank would do, just with the seller holding the paper.
Walk me through the mechanics. How does it actually work at closing?
It's just like a normal sale. The deal closes and the deed transfers to the buyer immediately. The buyer signs a promissory note laying out all the terms.
And that note is secured.
It's secured by a mortgage or a deed of trust, depending on the state. The seller then records a lien against the property in the public record. And just like that, the seller becomes the bank. They're a lien holder.
And where does this particular structure really shine?
Its beauty is in its simplicity and the clear chain of title. The buyer owns the property, which makes things like insurance, taxes, and any future transactions much cleaner. It works great when a property is already stabilized and the business plan is pretty low risk.
And it gives the buyer a clear exit path.
A very clear path. They can improve the NOI or wait for rates to drop and then refinance the seller out with a traditional institutional loan. It's a very clean-cut process.
All right, let's talk brass tacks. The deal terms. What are the typical ranges for the down payment, amortization, that kind of thing?
The down payment is usually somewhere between 10 and 30%. I know some people talk about zero down, but in the professional multifamily world, that 10% equity cushion is pretty vital for the seller's security.
And the amortization is long, right, to keep payments low?
Usually, yeah.
Yeah.
20, 25, even 30 years. That helps the buyer's immediate cash flow. But the key for the seller is the balloon payment.
That's the moment of truth.
That is the moment of truth. It's usually set for 2 to 7 years out, though we're seeing shorter ones, maybe 3 to 5 in this market. That balloon is what forces the buyer to either refinance or sell the asset. It's the seller's path to liquidity.
Okay, but even in this clean structure, there's a huge pitfall, a trap for the seller if they already have a loan on the property.
This is the due on sale clause, and it is the landmine you absolutely cannot ignore.
Explain it.
If the seller has an existing commercial loan, it almost certainly has a due on sale clause. And since this conventional structure transfers the title to the buyer, that action alone triggers the clause.
So the seller's original bank can just call the entire loan balance due immediately?
Immediately. It doesn't matter if the new buyer is paying the seller perfectly. It doesn't matter if the seller is paying their bank perfectly. The transfer of title is a technical default. The bank can demand full payment tomorrow
Wow, so that's terrifying. It could kill the whole deal instantly.
and force a desperate, expensive scramble for new financing. So this is non-negotiable due diligence. The seller has to know their existing loan is either paid off, non-existent, or has a clear documented waiver from the senior lender.
Okay, so let's say you're the buyer. How do you get a nervous seller, maybe a retiring owner, to say yes to this? How do you overcome that anxiety?
You don't talk about risk in the abstract. You talk about structured security. You talk about simplicity of enforcement. A smart buyer should come to the table offering the full suite of protections a bank would demand.
Like a strong down payment and a personal guarantee.
That's the start. But the real security is in the operational controls. You need to offer DSCR covenants, requiring the property to maintain a certain cash flow margin, say 1.15x, monitored quarterly.
And financial reporting.
Mandatory, detailed financial reporting,
Right.
not just once a year, monthly or quarterly T12s. You mandate that taxes and insurance are escrowed, and most importantly, you draft ironclad step-in rights on management.
Meaning if things go south, the seller can take over.
If occupancy dips, if DSCR falls, the seller needs the legal right to step in and take over management immediately before their collateral value gets wiped out.
Now let's move to a structure that completely flips that risk dynamic on its head by changing when the title actually transfers.
Yes, this is the bond for deed. It's a really unique and powerful tool, specific to Louisiana, but it has conceptual cousins like installment land contracts in other states.
So what is the fundamental mechanical difference here?
The core difference is title retention. With a bond for deed, the buyer takes possession, they run the property, they collect the rents, they make the payments.
But the seller keeps the deed.
The seller retains legal title until the very last payment is made, or until the buyer refinances them out.
So the buyer's running the business, but the seller holds the ultimate hammer, legal ownership.
It is maximum security for the seller. Their leverage is absolute. They're thinking, if you default, I already own the property. The process to get you out is way faster and cheaper than a full-blown foreclosure.
And this is great when traditional financing is hard to get.
Exactly. It's a private path to ownership, especially useful if the buyer is a little light on cash up front, but has a proven track record as an operator.
So the buyer operates as the beneficial owner, enjoying the cash flow, but the seller just holds onto the title as their leverage.
That's it. Title only conveys at the very end. The price the buyer pays for that easier entry is accepting the seller's control and their security demands.
But the source material flags this as litigation bait if it's not drafted perfectly. What are the non-negotiable things you have to define to avoid a legal mess?
This is essentially a partnership with split control, so ambiguity is a ticking time bomb. You have to be explicit about a few key things. First, who insures what? The seller must be named as the loss payee and additional insured.
To make sure they get notified if the policy lapses.
Instantly. Second, taxes. Who pays them, when, and the seller needs proof. Third, major repairs, the CapEx. Who funds a new roof? If the buyer puts $500,000 into the property and then defaults, do they get any of that back? You have to spell it out.
What about control over the bank accounts?
Critical. Who controls the reserves? And finally, what happens to the improvements the buyer made upon default? Are they forfeited, or is there some kind of compensation? If you're vague on any of this, you might avoid a foreclosure, but you'll walk right into a lawsuit for unjust enrichment.
So the tactic for the seller here is to think like a lender, a very strict lender.
Absolutely. You have to treat this like building a mini-lender relationship. You demand professional property management, monthly financials, clear reserve requirements. You lock in your insurance standards. If a broker in Louisiana can master this structure, they can close deals that nobody else can.
Okay, let's move into the more advanced and frankly riskier plays, the structures that involve working around the seller's existing debt.
Yeah, these are not for the faint of heart. They rely entirely on the seller having some fantastic, low-rate legacy debt that both parties want to keep in place.
Let's start with subject to financing. What are the mechanics of this high-stakes move?
Okay, so the buyer acquires the property subject to the existing loan. This means the seller's original loan stays completely in place in the seller's name. They are still on the hook.
And the buyer just agrees to make the payment.
Right, usually through a separate unrecorded side agreement. And in most cases, the title does transfer to the buyer at closing.
So the buyer owns the property, but the seller is still personally liable for the debt. Why on earth would anyone do this?
Only for one reason. The existing loan has amazing terms that are impossible to get today. Maybe it's a 4% loan in a 7.5% market. This is the only way to preserve that cheap capital.
But this brings us right back to that monster risk we talked about.
The due-on-sale clause. It's the defining existential risk of this structure.
Because title transferred.
Because title transferred. It's a clear technical default, and the lender can call the loan. And we need to be clear about how they find out. It's not usually a random audit.
It's the paper trail.
It's the paper trail.
Huh.
The new insurance policy has the buyer's name on it. The county tax bill gets mailed to a new address. Or maybe the loan payment starts coming from a different bank account. A sharp servicer will spot that, connect the dots, and then the notice demanding full payment goes out.
And the seller is still on the hook. If the buyer flakes, the bank goes after the seller, ruins their credit, everything.
Their liability is absolute until that loan is paid off. This is why you can only do this with extreme sophistication. A scalpel, not a hammer. It requires ironclad indemnities from the buyer and crystal clear disclosures that this is not a bank-approved deal.
What about those more advanced tactics, like using a land trust to try and hide the transfer?
Right. So in a high-risk play, some might try to transfer the property into a land trust and then sell the beneficial interest in that trust to the buyer. The idea is that since the public record still shows the trust as the owner, you might skirt the due-on-sale trigger.
But that sounds incredibly risky.
It is. Many modern loan documents now explicitly define a transfer of beneficial interest as a trigger, same as a title transfer. It's an aggressive, legally complex strategy that's in a very dark gray area of real estate law.
Okay, now let's talk about the wraparound mortgage, or a wrap. It's sort of a cousin to subject to, but a little more structured.
It is. The seller still has an underlying loan, but here the buyer signs a new, larger note to the seller that wraps around the existing debt.
So the buyer makes one payment to the seller.
One single payment. And the seller then takes a portion of that payment and continues to pay their original bank.
The genius of the wrap is the spread the seller can make. Can you break down the math with an example?
Sure. Let's say the seller has an underlying $7 million loan at 4%. The sale price is $10 million. Buyer puts $1 million down, so they need a $9 million note.
Okay.
The seller offers the buyer a wrap rate of, say, 6.5% on that full $9 million. Now, the buyer pays the seller 6.5%, but the seller only owes 4% on that first $7 million to their bank.
So on that $7 million, the seller is netting a 2.5% spread.
Exactly. It's a risk-free yield as long as the buyer pays.
Yeah.
And on the other $2 million of their own equity, they're earning the full 6.5%. It turns them into a high-yield lender.
It's easy to see why they're popular, but the core risks sound exactly the same as subject to.
They're the same twin risks. First, due on sale. If the underlying loan prohibits it, the bank can call the loan. And second, there's a huge performance risk. Well, the buyer could pay the seller, and the seller could just pocket the money and not pay their bank. That's fraud. Or the buyer could stop paying, and now the seller is forced to cover the underlying mortgage payment themselves to protect their own credit.
This is where the source material was adamant. It said professional loan servicing is non-negotiable for a wrap.
Mandatory. You have to use a third-party servicer. They're a neutral fiduciary. They collect the buyer's payment, and the very first thing they do automatically is pay the underlying senior lender.
So it removes the temptation and the risk.
It completely eliminates that performance risk. They track everything, they send notices, they create an official payment record. It might cost a few $100 a month, but it can save you millions in litigation. It's an absolute must.
Okay, so let's shift gears. We're moving from structures where the seller is the entire bank to situations where they just help bridge the equity gap behind a new bank loan.
Right. This is the seller second, or seller carryback.
Okay.
And it's probably the most common and institutionally relevant form of seller financing you see today.
So you're blending bank capital and seller capital.
Exactly. But it brings a third party to the table, the senior bank, and they hold all the cards. They dictate the rules.
Walk us through the mechanics of a seller second, and let's use a clear capital stack example.
Okay. So the buyer goes out and gets a primary senior loan from a bank, maybe for 65% of the purchase price.
Oh.
That's the first mortgage.
Right.
The seller then agrees to carry a second note, which is legally subordinate to the bank's loan, for another, say, 25%.
Which means the buyer only needs to bring 10% cash.
Exactly. On a $10 million deal, that's a $1 million cash requirement instead of a $3 million one. For the buyer, it's a huge leverage enhancer.
And where does this structure shine?
It's perfect for that classic equity gap scenario. The deal is good, the property is solid, but the buyer is just short on the cash the bank demands. It lets the seller get a higher price, transfer title immediately, and still earn a nice yield on the note they carry back.
It's also the seller saying, I believe in this deal.
It's a huge signal of confidence. I'm willing to keep my own money in it because I trust you as an operator and I believe in the asset.
But the whole thing hinges on what the senior bank will allow. It's all about their intercreditor requirements.
This is the critical factor. The senior lender has all the power, and they exercise it through a formal intercreditor agreement that the seller has to sign.
And what's in that agreement?
They'll cap the combined LTV, maybe at 85%, to ensure there's real cash equity in the deal. They will dictate the terms of the seller's note, and they'll put strict limits on payments.
So they might say the seller's note has to be interest only.
Or even that payments are deferred entirely until the property hits certain performance goals. The bank wants every available dollar of cash flow going to service their senior debt first.
But the most painful part for the seller is something called the standstill provision. Explain the horror of that.
The standstill provision says that if the buyer defaults on the senior bank loan, the seller's not allowed to do anything. They can't accelerate their note. They can't start foreclosure. They must stand still.
So they have to just sit there and watch.
They have to sit and wait, sometimes for months or even years, while the bank figures out what to do. The asset could be deteriorating, the buyer isn't paying anyone, and the seller, who's owed millions, has their hands completely tied.
That's why underwriting the buyer is so critical.
It's everything. If the buyer is a bad operator, the seller in second position is the one who gets wiped out.
So the tactic here is to structure the seller's note creatively to get the bank comfortable from the start.
You have to structure it defensively. First, make the seller's note strictly interest only, with a balloon payment timed to come after the senior loan's maturity.
That minimizes the monthly cash drain.
Right. And second, you can make part of the seller's yield contingent. This is often called a soft second. For example, you could say the first 4% of interest is fixed, but the next 2% only gets paid if the property hits a 1.3x DSCR.
So it becomes a performance-based payment.
And the bank loves that. It reduces the property's fixed costs, which makes their first lie-in position even safer. That kind of creativity is what gets these deals done.
So we've covered 5 structures now. Let's pull this all together. Let's consolidate the big benefits that get both sides to say yes, and then hammer home the critical defensive moves.
Right. For the seller, the benefits are clear. First and foremost, they get a higher sale price. They get closer to their target number than any bank-financed offer could support.
And they get a bigger buyer pool.
A much bigger market reach, absolutely. They also get a reliable monthly income stream at an attractive yield. And as we discussed, the potential tax advantages can be massive.
And sometimes, with the right controls, they can actually be more secure than just taking cash from a buyer who's over-leveraged.
Absolutely. They know the asset better than anyone. They can structure protections that a distant bank might overlook.
Okay, now for the buyer. It's really about speed and flexibility.
It's a complete game changer. You get a faster closing with fewer hoopsless appraisal drama, fewer lender conditions.
And the flexible terms are everything.
Paramount. Getting an interest-only period, getting lower DSCR constraints, tailored balloons. That's stuff you can never negotiate with a bank. It all leads to higher blended leverage, which lets them preserve capital for operations or their next deal.
And it all serves as that strategic bridge to a refinance.
That's the end game.
Oh.
Use the seller financing to stabilize the asset, raise the NOI, and then 2 to 5 years later, you take the seller out with permanent institutional debt at a much higher valuation.
Okay, but none of this works if it's not secured properly. Let's get into the 3 critical defensive tactics. Tactic 1.
The seller must underwrite the buyer like a lender, period. Too many sellers get emotional about the price, and they completely skip the due diligence on the person who will be managing their collateral.
They forget they are the bank.
And they're essentially donating their equity to a totally unvetted operator. It's a recipe for disaster.
So what's the checklist? What does a seller need to demand?
You need the buyer's full personal financial statement. You need proof of liquidity outside of this deal. You need their experience resume. If they're new, who is their property management partner?
You also want to see their business plan.
You have to review their detailed CapEx plan. And then, this is where amateurs fail, you run comprehensive background checks and a litigation history search.
For real.
For real. I've seen sellers get charmed by buyers who had a string of lawsuits for mismanagement. The seller ignored the red flags because they loved the price, and 18 months later, their collateral was ruined. If a buyer has a track record of destroying assets, you need to know that.
That's incredibly disciplined. Okay, tactic 2.
Define default like you expect it to happen. Default is not just missing a payment. That's the baseline.
It has to be broader.
It has to be a comprehensive list of operational failures. Failure to pay taxes, failure to maintain insurance, failure to provide financials, unauthorized transfer of the property.
And waste. Decline in the property's condition.
Yes. If the parking lot is crumbling and they're letting units fall apart, that deferred maintenance is eroding your collateral value. That needs to be a default trigger long before they ever miss a payment. Ambiguity here is just an expensive mistake waiting to happen.
And the final tactic, number 3, is about controlling the cash.
Tactic 3, control the cash flow when appropriate, especially in a high-risk deal. This starts with mandating third-party loan servicing.
We talked about that.
And on bigger deals, you might even need a lockbox for the rents.
So all the income goes into a controlled account first.
Exactly. And a servicing agent executes a payment waterfall. First, taxes and insurance get paid. Second, the senior bank gets paid. Third, the seller gets paid. Fourth, reserves get funded. And only then, whatever's left over, the surplus, gets released to the buyer.
And the buyer's reaction to these kinds of controls tells you everything.
It tells you everything you need to know. If a professional operator pushes back hard on basic things like financial reporting or reserves, they're telling you who they are. They're telling you they prioritize their own pocket over the health of the asset.
Okay, let's distill this down to the ruthless takeaways, the final points that really separate the pros in this space.
There are 2 principles that apply to every single one of these structures. The first one is the most important.
And it's that structure is more important than rate.
Infinitely more important. Amateurs get hung up on rate. They'll fight over 50 basis points. Professionals negotiate structure.
So what does that mean in practice?
It means the focus is on the down payment, the balloon timing, the amortization schedule, the reporting requirements, the personal guarantees, the refinance triggers, all the defensive architecture.
Give me an example.
A seller who takes a 6% note but gets a 30% down payment and full escrow control is in a far, far better position than a seller who got a 7% rate but only took 10% down with vague default language. A fair rate with strong controls is a great deal. A slightly higher rate with lousy security is a terrible deal.
Structure is security. The second point is just as critical. Build an exit path on day 1.
You cannot base a deal on hope. Hope that rates will drop in 3 years is not a strategy. Every deal needs a clear, how does this end plan baked into the documents.
So a defined refinance window.
A defined window, say 24 to 48 months. Specific performance milestones the buyer has to hit, and explicit options to extend the note, but always for a fee.
To incentivize them to get it done.
You need to incentivize the exit, and in some cases, you might even need a forced sale provision. If the property isn't performing by year 4 and the buyer can't refinance, there has to be a consequence that allows the seller to step in and list the asset to get their capital back.
So let's bring this all home for the professional, the broker, the investor listening right now. Why is mastering this stuff the key to winning in this market?
Because the reality is undeniable. Most owners want a price that today's bank debt can't support, and most buyers need help bridging the equity gap. Seller financing is the only bridge. It's the only tool that makes the transaction possible.
So if you're a broker and you're not pitching these structures,
you are leaving deals and money on the table. Your listing is going to expire while the broker down the street who understands this stuff is closing deals.
The winning strategy is being a capital solutions expert.
Exactly. You educate sellers with example term sheets. You pre-build a structure menu of common capital stacks. You coach them on the difference between vague risk and structured risk. Risk that's mitigated by controls and reserves. The broker who can structure wins. The broker who can only market loses.
That was an incredibly detailed deep dive. We've covered the 5 crucial structures: conventional, bond for deed, subject to wraps, and the seller second, and more importantly, the defensive tactics you need for each. The takeaway for me is that clarity and control are just so much more valuable than chasing an extra quarter point on the rate.
We've seen that seller financing is the key to unlocking deals when banks are conservative, which really raises a bigger question for this sophisticated investor listening. If this kind of structured private capital is proving superior to plain cheap debt right now, what other non-traditional lending mechanisms should you be mastering? Things like private debt funds, hybrid revenue share models. You need to be building a toolkit that makes you transaction ready no matter what the banks are doing. That's how you build resilience.
Thank you for joining us for this deep dive. We hope this knowledge empowers you to structure the next deal that nobody else can close.